Hey folks, it's Ace Trading here with another weekend review. So last week was a bit volatile. We'll discuss some of that in this session, but we're going to discuss some of the high level observations about the state of the market and the internals, and get into some thoughts on how to approach the coming week. So let's just dive right in. So between the CPI and the Fed announcement, the major indices gap down. What day is that? Wednesday. So that looked pretty nasty on the day of. You can see this thing gap down on the IWM. And then the very next day, there was the PPI. Everything was looking great. So it was like this kind of back and forth chop and slop. A lot of people jumped in on the PPI report because, this bar looked nice and strong. And then the next day, you kind of had the morning after pill. Everybody just gets dumped on. And that tends to be what happens, regardless of the news. When the market gets into a selling mood, oftentimes it'll rally just enough to suck enough suckers in, and then it'll kind of screw them over, which is exactly what we saw on Friday. As I indicated in a recent post on X, these highs keep getting lower. We're starting to get lower lows on some of these indexes. The Qs, they're starting to build lower lows, but I would say the 50-day here, if we cut through that would be kind of the nail in the coffin on the Qs. But the small and mid caps, they're pretty much just toast right now. The IWM is below the 50-day now. It's significantly below its most recent pivot lows, and so is the mid cap index. And there's a chance the mid caps could bounce here just a little bit, but as these moving averages start sloping down, they end up becoming resistant. So you'll see a lot of times the index will rally just enough to kind of run into its declining 10 and 20-day moving average, and then it'll just kind of keep dropping. And that just tends to be what happens. So you can see by the lack of check marks here and also the way that these moving averages are sloping down, that all the major indexes are below their 10 and 20-day moving averages. And then if you look at the internals, you have almost twice as many new lows as you have new highs. Actually, almost 3 times as amount of new lows as new highs, and a significant divergence in the stocks that are expanding to the downside versus the upside. So you have 500 here versus 2,000. So that's a pretty good indication that the weight of evidence is showing the average stock is not doing so great. More stocks are hitting new lows than new highs. More stocks are expanding to the downside than the upside. As a long side trader, that's not the background that I like to be operating in, at least aggressively. I might put a feeler out here or there just to kind of test the waters, but absolutely in no way in this sort of scenario would I be even remotely thinking about being aggressive on the long side. Just the state of the indexes are negative, the state of the internals are negative. If we get over here to the sector chart, you can see like most of these check marks are gone, which means that most of these indexes, most of these sector indexes are having downsloping 10 and 20-day moving averages. And you can, like I said in a previous post, you can tell by just the composition of the leadership here that even the leading groups, which are supposed to be energy, this day on Friday was extremely negative, massive wide-ranging bar. I don't even have to go too quickly through these charts just to show that things are not in a good state. Even the leading sectors are not really leading very well. So that just kind of goes to show that it's just an overall general negative state of the market. When you look at the weight of evidence, whether it's looking at the big picture indexes, whether you're looking at the breadth of new highs versus new lows and up and down momentum, as far as like looking under the hood, those are all negative. And I'm sure folks that are trying to buy things are also experiencing negative on a stock by stock level. I can't imagine too many of your stocks are doing so great right now, and they probably haven't been for the last few weeks. I haven't put on a single trade in several weeks. One, because I was on vacation in Florida and I just completely disconnected from the market. Something that I would encourage you to do at least once or twice a year. Just unplug everything, disconnect, don't even log in. Go to cash position, kind of clear your mind, clear your head, and start with a fresh slate. And when I came back, this is what I came back to, and I'm like, okay, it looks like I'm not going to be doing much for a while. So it is what it is. I would not try to guess how long this will last. Some corrections last just for a week or two. Other ones last for months. Those of you who have been trading long enough, some of them last for several years. When I started trading in the early 2000s, we had a 3-year bear market from 2000 until almost, the middle of 2003 almost. So that's a multi-year bear market where, you get these short-lived correction counter trend rallies, and that might last for a few weeks, and then it's back to downtrend, back to everything kind of bleeding out. And it was a pretty rough time. And that's the thing with this sort of situation. We don't know how long this will last. So those of you that are inclined to be bottom fishers or trying to pick the lows, I would offer my vast experience over the last 20 plus years that is not a great approach. And more often than not, you end up too early. You end up getting slopped around a lot. You end up making the drawdown that you have much, much worse than it would have been if you had just sat on your hands, sat on the sidelines, and just waited for a little bit more confirmation that the bottom is in. So at this point, what should we be looking for as far as when we think the market might have bottomed? And I promise you that's not going to happen next week, probably not in the next several weeks. But what you want to see is this pattern of lower highs and lower lows. You want to see it turn around to where you start building a higher low, and then you start building higher highs, and you're kind of going in the opposite direction. The moving averages start sloping upwards. The internals start getting more positive, where you have more stocks hitting new highs than new lows. You have more stocks with an upward momentum than a downward momentum. Because right now, you can imagine it's like trying to swim with a 20-pound weight tied to your feet. Yeah, sure, you can swim, but there's going to be a point in time where it's extremely difficult. And trying to find any stocks that are going to go up on the long side at this point in time, it's like finding a needle in a haystack. If you're inclined to short or do things of that nature, then that's on you. That's not really something I'm interested in or that I do with my portfolio. But that's another thing I would also caution folks against, is trying to play both sides of the market. Unless you are really disciplined and you know what you're doing, there's a tendency to kind of get blindsided, or have blinders on, to where you're looking for all these short setups and your focus is really on the short side, and then sometimes you kind of miss those subtle clues as far as the shift change whenever things start getting set up on the long side. And then a lot of times you start missing the optimum time to get in on the long side because you're sitting there hyper focused on your short positions. Ask me how I know. I played that game too long, and I just ultimately, after a lot of back and forth and trial and error with that sort of thing, I just kind of decided I'm just going to be a long side player. I can make plenty of percentage return on just playing the long side. Even if there's only 1 or 2 rallies a year, that's still plenty of opportunity for me to make far more than what I would make just with things sitting in, like an index fund or something. I don't have to play the short side. And once I realized that, it kind of was empowering that it's okay if I sit on my hands and I just kind of do nothing for weeks or months on end. And if you can't do that, then you might want to think about why you're trading. You might have more of a gambler's mentality than you think you do, or you're looking for excitement or something to do. Trust me, I've been there. I'm not judging anyone at all. I've been at this game for a long time, and sometimes you learn lessons the hard way. But ultimately you do you, and it's your money. So that's just the state of the indexes, the sectors. Even if you look at the industry indexes, you can just see the composition of what's in this top. What is this, the top 20 sector or industry charts? It's a lot of materials and industrials. It's just the composition even of this top segment of industry groups is not super encouraging. And then even if you look at these tech representations, you've got internet content, which that one's still doing okay, but this one is below all the key moving averages. Semiconductor is below all the key moving averages, looking like it's about to break down. Computer systems, same thing. Just this really nasty negative bar to the downside. Electronics, not quite as bad. It's still above its 20-day, but you can see it's not great encouraging action. So even in the areas that I like to play, technology and I don't see consumer cyclical represented anywhere in this top 20. So it's just a lot of kind of negative action across the board. It's just not my cup of tea. And then if we look at just kind of like all of the stocks that are available in the top relative strength group. So I just have this basic scan. I think I've shown this before. It's just the top 5% of these 4 different kind of time frames: 2 weeks, 1 month, 3 months, 6 months. And I know these aren't exact. This is just kind of rough estimates of those time periods. And I'm just looking at the top 5% of relative strength leaders in that group. Some basic liquidity, 10 million daily dollar volume, which that's pretty low. And then 300,000 shares average daily volume. And that's just to kind of weed out the stuff that is super thin and things that I just don't really want to be messing with. Average daily range, 4% or higher. I want the 10-day moving average to be above the 20. And then I want things to be within 15% of their recent highs. I don't want to be looking at things that are just nose bleeding off their highs, just way off the highs, because it kind of goes back into that overhead resistance thing that I've talked about recently. So I want things that are kind of setting up, consolidating near recent highs and have, some amount of relative strength, liquidity, volatility, trend, things of that nature, just basics. And what we end up with is 52 stocks. I think when I ran this scan a few weeks ago, it was like 150 or 130 or something like that. So you could just see the just degrade of the amount of stocks that are on this list. And that's a good indication by itself. When this number starts to expand, that means you have more and more stocks that are basically in an uptrend, near recent highs, and they're kind of showing up based on this other criteria. The main things that are going to drop things off this list are when they drop below the 10 and 20, which a lot of stocks have done recently, and they drop too far off a recent high. So even just these bottom 2 filters here are a great way to kind of gauge what is the average stock doing under the hood when it comes to the high relative strength stocks. And when you start seeing a number like this, 52, when it's typically in the hundreds, that's a pretty good sign that a lot of things have kind of degraded under the surface and not really a great backdrop. But we'll play the game. We'll go through this anyway. And like I've shown you before, if you just take the short-term volatility, which is this 3-day volatility average divided by a longer-term average, like the 20-day, it's a good way to kind of see the smaller the number. So basically on this small end, this is when you start getting into stocks that are like contracted relative to their average volatility. And then when you get to this very high end, when you're far over the 1 value, then the stock is extremely volatile relative to its average. So out of the 52 stocks, if we just look at ones that are 1 and above, there's 30. So basically more than half of this list, far more than half of this list has a volatility above 1 on the short term relative to its long term. That means there's not a lot of stocks that are compressing and contracting and kind of giving that tight sort of range that you're looking for prior to entry. So even before I even look at this pile of stocks, I know that it's not going to be promising straight out of the gate. And if we start on the very volatile end, you'll see these are the stocks that have kind of made a move recently. As I stated before, this is a good way to study stocks that have made a move that week or in the last week or two. And it'll kind of, as you look at these lists over and over and over again over time, it'll give you an idea of what a stock looks like when it expands, where does it expand out of, what does the price action look like, what does the volume look like. It's a good way to learn kind of what to look for in the progression of an expansion move. These aren't ones that I would necessarily trade because they've already moved. And you can see as I go down this list, you'll see some nasty, sloppy bars. Look how huge that bar is on AG. I think a lot of these metals kind of got tore up on Friday is what it's looking like. But you can see just going through this list, there's not really a lot of tight action going on. And just to refresh, and again, I like refreshing on this methodology because this is exactly what I do every single week to kind of prepare myself for the week. I take the whole universe of stocks, I run it through some basic filters because I want to take this massive list of 6,000 plus stocks and get it down to something a little more manageable. And then I take that manageable list. Like I said, this is normally 100 to 200 stocks. Right now it's at 52, so that's a good sign of the state of the market. And then I basically look at the setup and the context of those stocks to see if it's in a state where I want to trade it within the next day or two, or maybe the next week. If it's not, I just wait. If I don't have any setups, then I do nothing. I don't go hunting for setups when there's nothing to do. And then as far as triggers, I'm looking for price and volume breakouts, and then that'll give me the list of stocks that I trade on a daily basis. Or I trade nothing. There's often days where I don't trade at all, and that's perfectly fine. I would highly encourage that. If you're trading every single day, unless you're a day trader, then you probably are not as critical as you should be with what you're getting into, and you're maybe just kind of an action junkie looking for something to do. Because I even know some very, very successful day traders who don't trade every day. They have, out of a 20 trading day month, they probably have 3 or 4 or 5 days out of that month where they don't even trade. They don't see the setups they're looking for. Maybe they feel like their mental state is off and they need to take a break. But even day traders that I know that are very successful don't trade every day. So if you're a swing trader or a longer term trader and you're trying to trade every day, then you might want to consider your motivations for trading. Again, this is the kind of stuff we're looking for. We're looking for this kind of tight sideways consolidation, 3 to 10 days. And this is StockBee's criteria. It's, if you look at these links here, you can pause the video, go to these links. This is the origin of this information. So sideways consolidation, not up 3 days in a row. You want this kind of tight contraction, and on the breakout day, this is what you're looking for. This expansion out of this. So this is the contraction, this is the expansion, this is the contraction. It hasn't expanded yet. So this is what an anticipation setup looks like. This is what a setup looks like on the breakout day. And I know I repeat this a lot. I say this often. I show this same slide often, but there's a reason for that. This is what you should be looking for in the context of a good market backdrop. So that's what I want to caveat right now is like, this is great. This is exactly what you want to be looking for, but you can't ignore a negative market backdrop, because most of the time, even if you get a clean looking breakout like this, if the market backdrop is poor, it's just going to roll over and die. So you're going to get sucked in on this breakout because you think everything looks great, and then it's just going to not follow through. Because at the end of the day, we don't get paid off the setup. We don't get paid off the breakout. We get paid on follow through from the breakout, from the setup. Like, those things have to be in order. It doesn't matter how beautiful the setup looks. It doesn't matter how great of a price entry you got. If it doesn't follow through, then you're going to end up, either scratching or with a losing trade anyway. So like, you want to be in a backdrop that facilitates follow through from your buy point. I can't emphasize that enough. Follow through from your buy point is one of the most important aspects of making money in trading. If you don't get follow through and you don't get it on enough stocks, you will never have positive expectancy. I guarantee you. You can cut your losses all day. You can be rigid with your losses. You can be great with your risk management, and then you'll die a death by 1,000 cuts. Tell me I'm wrong, but look at your equity curve recently and let that be the answer for you. But anyway, enough of that. So in a good market backdrop, this is what we're looking for. I do not consider this a good market backdrop, so I'm just going through the motions here just to show you what is potentially out there. Like this max linear, this is looking decent here. It had a nice thrust up. It's kind of consolidating along the moving average here. So I mean, this I would consider a decent looking start. But again, like, this thing would have to kind of break out of this range to the upside to kind of get out of this little consolidation area here. So this is a decent looking setup at this point. This is another one that's like, it's bouncing off the 50-day. You can see last time it bounced, it had a nice move off. So it's kind of doing a similar thing where it's kind of pulled back to the 50-day. So if this thing can kind of wedge pop back through the moving averages, that could be a playable setup here. This thing, it's looking not too bad. It's a little on the lower end of the ADRs that I like, but overall not bad. So that could be one if it can break out of this area here. This one had a pretty nasty bar on Friday. It's not really, the lower I go down this list, the less likely I'm going to find something that actually has the tightness and the kind of setup that I'm looking for. This one isn't looking too bad. Looking a little cup and handle-ish. Looking for a 3 to 10 day consolidation. Nice tight price action. This one's not looking too bad, I guess. I mean, I would like this to kind of flag out for a few more days, but you can kind of see it's starting to build something out. Not good action. This one tried to break out and got reversed on Friday, which a lot of stocks did, so not surprising. It's also a metals stock, so I think the metals got kind of tore up on Friday. But yeah, as I go through this list further down, I'm not expecting I'm going to find anything. And even though I have a couple of stocks that I'm like, oh, that looks decent, I'm probably not going to trade them anyway because of just the state of the market right now. I've spent too many years getting jacked up in choppy, sloppy, downtrending markets where I'm trying to weasel my way in, but I usually just get weaseled out of my own money. So I kind of learned that lesson the hard way. Not once, not twice, not even 5 or 10 times. I've been trading for a long time, so I've made far more mistakes than most of the people listening to this. So, but anyway, I'm not going to go through this whole list. What I really wanted to emphasize is, again, the state of the market is not very great right now for a long side trader. If you're a short side trader, then you do you. I do not see myself trading anytime in the next week, probably 2 weeks, unless this situation just, for whatever reason, changes. I do not see myself trading anytime soon. So it is what it is, and this will last as long as it lasts. I've been doing this long enough to know that anybody that thinks they know, or they guess, or they say they know, they're just lying, or they're trying to sell you something. So I would I would take caution. Anyway, I hope you have a great trading week coming up, and I hope you found this weekend review to be helpful. Thank you.